All right, hey everybody. So my name is Aaron Dinin. I teach here in the Innovation Entrepreneurship Initiative. I just started teaching in the P4E program this year, so we're kind of experimenting with that. I think I'm taking over New Ventures 1 next semester, so we'll see how that goes. Probably not well. But I spent about 5 years teaching in I&E before that, and actually during that, I did a variety of venture-backed tech companies, venture-backed failures, I like to think of them, kind of each successive level of successes. First company, didn't really raise anything. Second company, I kind of realized how to raise a little better, but it still didn't work out. Third company, got even better at it, and it's still alive. So I guess that's a good thing, or a bad thing, depending on how you want to look at it. So I've done a lot of, spent about a decade in venture-backed tech companies raising capital, but my side of the table is always the entrepreneur side. So I'm excited we've got 3 great panelists here. 2 of them I know sit on the venture side. One sits on the founder side specifically, and I know Salman, I think you've been on both sides, and hopefully we'll hear about your background as well. So I'll let them introduce themselves. They're going to do a much better job than me, so you can take it away.
Thanks. So my name's John Cambier. I'm one of the founding general partners at IdeaPhone Partners. We are the most active early stage investment fund in the Southeast for the last 5 years running, despite our diminutive stature. We are a generalist micro VC that targets kind of 3 main buckets of investment: enterprise software, tech-enabled services, and then what we call core technologies, which are those companies for which intellectual property forms the foundation of their value. We typically are not the very first money in a company. We're typically the second money in the company. So not that first seed kind of friends and family round, but that second seed pre-Series A. And we're kind of that bridge between the hyper-local angel capital and the really large national funds, 65 of which we've co-invested with over the last 10 years.
Sean?
Hi, I'm Sean Harrison. I am currently the CEO of a company called WizeView. We are an early stage technology-enabled service. I'll talk more about it during the panel, I'm sure. We have not raised capital for this fund for this company in the last 9 months since we started it. We've bootstrapped the entire thing and are revenue generating. Previously, I have been in a company that John invested in, and that company is still going, though I don't think John's in it any longer. I think he was cashed out in an incredibly big way.
Yeah.
Okay, I won't say any more. I at a college many years ago, worked for IBM and then left and did a early stage company. We had some success with that in the late 90s, and then did a couple other early stage software companies, started a nonprofit, worked in that for a while. I'm currently in kind of healthcare technology. That's the area that I operate in.
Hi, I'm Salman Azhar, and I started my career really as a professor and then turned into an entrepreneur. And did that from about 96 to 98. So one of the things that is still kind of going on that I started was the tracking of packages by UPS and FedEx. So when I was doing it, we were doing it at a truckload level. Now it is being done at individual package level. So when you sign for a slip, that's basically the kind of evolution of what we started over in Winston-Salem, North Carolina, believe it or not. So in 1998, I moved to Silicon Valley. From 98 to 2008, I launched one company after the other. And the companies that I launched were very much like launching full court 3-point shots. Most of them failed. A couple of them succeeded. Actually, 4 of them succeeded. And then in 2008, I did my last startup. And the interesting thing is that every startup I did, I called it my last startup. But in 2008, I actually did my last startup. And that failed because of the economy tanking. And I realized that the valuations are really, really cheap in terms of investing. So I became an investor at that time. So it is kind of opportunistic kind of life, and the defense always gives you the full court 3-point long shot, so I always take that, and that's one of the things that brought me to the investing side. And since then I've been advising companies and investing companies and just generally helping things. That tells me I'm late for this meeting, so I just switched phones from iPhone to Android, so I don't know how to turn this thing off, so hopefully I'll be able to figure this out.
So was that it? So,
that's it.
We
that's
should mention
it. That was my cue to stop.
Okay. Said a few more of those, if you don't mind. So I want to, when I was asked to moderate a panel on raising capital, it struck me that there's kind of two sides of this coin. One is are you on the founder side trying to raise capital, or are you interested in being on the VC side and someone dispersing capital? And so I kind of want to get a sense of hands. How many people in here are here because they want to learn about the founder side? And so it looks like we have both. So how many people are here because they want to learn, they're interested in possibly going into VC on the venture side? Oh, so we got both. Okay. I just wanted to make sure, because if there was only one or the other, then we would ask kind of very specific types of questions. Okay, so my first question, so let's lay the groundwork here, is to say, one of the hardest lessons I had to learn as an entrepreneur was to understand that venture capital isn't for every kind of company. This actually is really critical to understand that. So I wanted to ask, first, I guess maybe you, John, what kinds of companies should be raising venture capital?
Yeah, so I think the kinds of companies that should be raising capital are the kinds of companies that have massive opportunities and relatively short windows on which to execute upon them. And I think most people are cognizant of the first and less cognizant of the second. It's important to understand the window of opportunity that you're executing against, because it might actually indicate that you have a good shot at organically growing the business and maintaining full ownership of it as opposed to diluting yourself, whereas it might also tell you that one of the largest competitive threats is that if the market opportunity is what you think it is, that you're going to have other competitors in it and that you need to execute at scale relatively quickly. And that's what venture capital really is. I mean, there's an analogy or a metaphor, venture capital is kind of like rocket fuel or steroids, and that's good and bad, right? I mean, it can make you blow up or it can make you go really fast, or both, but it's not for everything.
Yeah, I think Dad kind of agree.
Yeah, so generally you're looking for, if you're from an investment side, you're looking for a pop in the business. You're not looking to invest in restaurants for cash flow and stuff. They typically do better with high interest loan, and it doesn't make sense for them to raise money as well. So you're looking for pop, and typically if you're on the investment side, you're investing in 10 to 20 companies and hoping a few of them would really give you a huge pop, and most of them would go bust. And that's basically the equation.
Well, most of his.
Yeah, and I would also say that there really needs to be a reason that you're going to raise money. I mean, we've been able to reach a point now where we have a small amount of revenue each month, about $20K a month in revenue. We've grown it entirely on our own, and we're trying to prove the business and prove that we have a small market that we can dominate. And we're trying to get to a point where once we have that, the affirmation, then we'd look to say, okay, now we'll raise capital to either really blow through that entire market, or to look for other markets that may be larger opportunities, but we couldn't dominate one of the larger opportunities out of the gate because it's just not practical for a small company. In for example, our space is healthcare. We couldn't really go after large health plans at this point, but we can go after a smaller market. In our case, it's retirement communities, CCRCs. They have their reasons that they will benefit by what we can do, and they're a lot easier to sell. And there's 2,100 of them across the country. So we don't need John's money today to be able to prove that we can be successful in that space. We may decide to go after ACOs and health plans, in which case we really need to ramp up the business, and that's when we'd have an opportunity to potentially go raise venture at a reasonable valuation.
And that's a great distinction. It's the when/why to raise venture capital. I hear so many of my students come to me and they say, I've got a business I'm starting. How should I go about fundraising? I think, whoa, you might not even need to fundraise. You're only thinking about fundraising when the money's going to provide you some sort of important milestone.
Right.
Yeah, so one of the examples, actually, a company that came out of Duke, its name is Closure, started by Max Stern. You should look it up. That's a classic case. He went to a fundraising thing, and after talking to him, I told him that you shouldn't be raising funds at this time, because right now you're cash flow positive. You are in the phase where you are doing a proof of concept, and it's a great place to be at the proof of concept level and just getting market validation. And really, when you really want to go for the big pop, that's basically when you want to raise capital, because your valuation would be a lot better. Now, as an investor, it would be great for you to come in at that level and get a good valuation and trick an entrepreneur. I just don't believe that that's the way you establish yourself in the industry. If you establish yourself in a win-win kind of situation, then that's basically where things need to be. So at this time, it would be ideal for him to give a little bit of equity for some advisors, because that's what he needs more than cash. So cash is only part of the equation, a very small part, in my opinion.
And seems like a big part, maybe a bigger part than it is sometimes.
Yes.
Okay, so which is easy to say on the side when you have the cash, I realize too. So one of the, I think, fundamental things that I really want your help explaining is the business model behind venture capital, because I think in order to raise money, you need to understand, essentially your venture capitalists or investors, angels are your customers, right? So you need to understand what they need, not what you want. So would someone mind, anyone could take this on, a quick description of what is the business model behind venture capitals? Because that's a business, the goal is to generate revenue, right?
Well, the business model is we want to make money and we don't want any drama. So that's basically it.
So okay, fair enough. How are you going to make money? Let's put it that way.
So the way kind of I look at it is that we are investing in companies when their valuation is relatively low. Once that money goes in, it acts as a catalyst for high growth. And I think John, right? He mentioned that that essentially you're looking for that high increase in valuation, and that makes it easy for them to scale. So you're taking something that is that has been proven at a smaller scale and has some kind of a validation, and now you want it to kind of go to the mass market or go to a bigger audience. And when it goes to a bigger audience, the valuation of the company increases. As a result, your share increases.
Let me come at it from a slightly more technical scale. So a venture fund is typically a 10-year limited partnership, so there's a finite life to these, or at least everyone's intention is that there's a finite life to these. And so that's important to understand, that there's a life cycle to my business and to my funds. And in fact, I have to go out and raise money myself, so I want you all to have empathy for me, because we have to do it too. But that's informative for you when you're raising money, because A, you want to know where a fund is in its life when you're talking to them, because we have typically a 5-year investment period on the front end when we're writing our first checks, and we have a 5-year harvest period, if you will, on the back end, where hopefully these companies, as Salman said, are getting to scale. We exit when the company exits. There are some exceptions to that, but generally speaking, we're along with you until the end. And we'd like that to be as short as possible, relatively speaking, but we'd certainly like for it to be within the life of the fund. And if I'm investing in you, if I'm writing my first check out of year 5 of my fund, I'm going to have more ants in my pants than if I'm writing a check for you out of year 1 of my fund. And again, just a little more, so we're going to have typically a basket of somewhere between, say, 15 and 25 companies in the portfolio, so it is diversified. We are most likely going to have some that are zeros, so the ones that work have to really work. And our kind of hurdle rate that we have to believe when we write our first check, a company has the possibility to return 10x our money. over the life of the investment on an individual company-by-company basis, because most of them aren't going to get there. So the ones that do have to make up for the ones that don't.
So,
Yes. Questions. Are there some moments like when you disagree with entrepreneurs? How do you put people in the same page, or how do you solve this problem? Because from my understanding, entrepreneurs are really very important to our staff. So if you have different opinion with them about their future strategies or about the trend of the industries, how do you solve this kind of situation?
can we, do you mind can we come back to that question, because I want to get to that question. It's, I think we need to talk a little more about how venture capital works before we can kind of talk about how it interacts with. So let's hold that thought, because I want to pick up on, so I'm going to force the answers here, because this is something I never really understood as an entrepreneur. It took me a long time to understand is, where does the capital and venture capital come from?
It depends.
It's not magical, right?
So most funds raise their money from institutional investors, which are endowments, universities, insurance companies, pension plans. So again, these are things that are funding people's retirements, people's scholarships, stuff like that. Smaller funds like mine are more typically going to be raising from high net worth individuals, family offices, folks of that nature.
And so, and this is a key distinction that I bring up, right, is because the capital coming into venture capital funds is not looking for a 10x return on the capital they're putting in,
no.
Right? They're putting in money with the expectation that, if you're investing in 10 companies, one of those companies is going to give 10x return, and that's going to give something like a, 30 to 40% X on the money?
Yeah. So the way kind of, so just talking about venture capital right now, and then we will talk about angel funds a little bit later, because it's a different model. And John, please feel free to correct me if I say anything incorrect. Generally, the idea is that they will invest in 20 companies, let's say. And of those 20 companies, 2 would give them a 10x return, and that gives them their money back. And let's say X number of those companies just go out of business, and they lose all their money. It is those companies in the middle that are the ones that have a potential to exit positively, but also have a danger of folding, are the ones that they will be investing most of their times in and making sure that they will exit. And the number of those hits they get is going to ultimately determine their success in this business. Now, one of the things John mentioned, I just want to make sure that you understand, is that when John starts a fund, he puts in a lot of money himself, but most of the money comes from other people. And he basically, as a general partner, owns all the decisions of what the money is invested in, and the limited partners do not have much of a say. He may consult them, he may get their advice if they have a particular area of expertise, and if that matches with somebody that's raising fund. But mostly, it is going to be his decision, and his credibility in the market is going to determine who raises money and how much money they give. And you invest other people's money very differently from the way you would invest your money. So for example, with my own money, I do option trades, which are high risk, high return kind of thing. But if I get your money, I'm going to be a little bit more careful. I'm going to treat it with much more respect.
And I bring all this up and ask them to explain this because it's important from your perspective to understand their incentives, right? When they're looking at a company, they have to say, which company can be a 10x company? Can all of these companies potentially be that? And if you're not, it doesn't mean you're a bad company. It just means, hey, this doesn't fit what our responsibilities, right? Question related to that?
Along those notes, and turning it into the inventor side, is the list of basically who are your LPs opaque to the investees, to the people that you're investing in? Or is that a strategic decision as a company founder that you would want a venture fund with LPs that include maybe people in your market?
Yeah, so certainly from the perspective of the company, it's helpful if you are in healthcare, and I see your shirt. So it's useful when the investors in John's fund or other venture funds happen to have health plans or academic medical centers that have put their retirement funds in there, because that potentially opens doors. It's the truth of the matter is the company is ultimately going to be responsible for its own success, and you might have support through the partners in the VC fund as well as the limited partners, but I think my experience is that tends to get overplayed. I think the VC they have sector expertise and that is important, but ultimately I think if their LPs are in healthcare, is that really going to make or break my company? Probably not.
So this may be a good time to talk about angel groups because they have a slightly different model. So LPs typically stand back and wait for GP to queue them if they are interested. So I'm LP in some of the funds, and sometimes the GP would say, hey, look at this company, this is in your area, or this company needs help in a certain matter. So for example, one company that is in a fund that I'm an LP in wants help in conversion of unpaid users into paid users in a freemium model. So that's something that is my area of expertise, so I'm kind of helping them out. Typically, I would not get any compensation for it if it's just like a few calls, but if they want to engage me as an advisor or as a board member, then I will get a fraction of a percent of equity in that company. Now, angel groups are completely different. Angel groups, everybody makes their own decisions. So somebody who is leading the screening and the diligence would do all their work and kind of consolidate that into a report, have lots of Q&A that goes after that. But in the end, if let's say all of you are part of an angel group, you would decide which company to invest in and how much to invest in. If you are all LPs, then John would decide for you where your money goes. Now, in order for John to take on that responsibility, you typically pay John significant fees from management and carry. Carry gives him an incentive to invest in good companies because he makes more money if you make more money. In angel groups, it typically is a fixed fee. There is no incentive for the angel management to, no financial incentive for angel management to do that. But if I am not running a good angel group, people would leave me. If I do not pick good companies, I give them junk, they would leave very quickly. And the same thing in VC group is that they would leave very quickly. Now, a lot of you raised your hands in terms of investing sides. So understand that you are also competing for good entrepreneurs. And good entrepreneurs are generally going to Sequoia and all the top companies. So in order for you to get there, you have to put yourself up there. So it is very much like a Duke model that if you are trying to apply to Duke, even Duke admissions are very competitive, you are treated with respect no matter who you are. I mean, you may be coming from any place, like UNC, for example. You will still be treated with respect.
Don't get crazy here.
No, I'm not just kidding. By the way, I have tremendous respect for UNC. In fact, let me just go ahead and say that their MBA program in entrepreneurship gives their students a lot more practical experience than Duke entrepreneurship does. But Aaron hopefully would change that next year.
No pressure.
And so you alluded to something, and I think all of you can probably chat about this a bit. Something, again, I'm just kind of going off my experience. I apologize for that a bit, but I didn't understand this when I was first raising capital. I thought of investors as these kind of other, these people with lots of money, right? Like that's how you see them. And I didn't understand that they're actually entrepreneurs too. They're much more similar to the work I was doing every day than different. And once I understood that, I was able to have much stronger conversations that engage them in more useful ways. So I just was hoping you all could share your experiences to kind of help demystify investors and explain, no, investors are basically running small companies themselves. And how that puts them into very similar positions as entrepreneurs.
Well, as I said, I mean, the one thing that a lot of people don't think about with venture capital is the fact that we have to raise money. And we have to raise money on a pretty predictable cadence of anywhere from every 3 to 6 years. And the thing that my partner and I learned is that it's a sales process. I think whether you're doing it as an entrepreneur or whether you're doing it as a VC, if I had to leave you with one thing as far as raising money goes, I would say you have to understand and treat it like it's a sales process. It's all about the numbers and it's all about the process. And my partner and I live in Salesforce, just like any other sales team. The difference is the product you're selling is an investment product, and it's either your company and you, or it's our fund and us. So I think that's an important thing to understand.
Yeah, and I think the other aspect of it is when you enter into a relationship with a venture fund, when they invest in your company, it's the cliche is it is a marriage because you're
only longer.
Yeah, only longer, yes. And they come to your board meetings, they're involved in calls. But the best scenario is things are going well and everybody's happy, and that then you see them less. When things aren't going so well is when you end up realizing, is this a good marriage, and hoping that you are effective at working through it. And I think in more cases than not, as you might imagine, spreadsheets and reality rarely meet. Right. So when you have these presentations at the beginning and everybody's excited and you're in the honeymoon, and then 6 months later, your sales targets aren't quite aligning, that's where the relationship really tests its mettle. And then over time, you work together to figure out what are the opportunities, where you have to adjust. But really, it's the company that's doing that. The board part, your advisor, your board member, they're not there day in and day out. And if they're overruling the CEO of the company, you've got big problems.
So a couple of personal experiences here that I, as an entrepreneur, in fact, this was my last startup where VC lost money, a significant amount of money, and last year I met her. We pinged each other, and because she was visiting Duke, and then I met her at Silicon Valley, and I was really concerned and really guilty that I lost a significant amount of money, an undisclosed amount of money, as they would say, and she gives me a hug, and I'm like, wow, I lost money and you gave me a hug. And I was just like very authentic with her and saying that you don't have any hard feelings about that. She said, no, I know that you worked hard and you kept me informed. So it is a multi-stage process. So if you are an entrepreneur that just ghosts the investors when you are in trouble, you would never get invested in again. But if you're an investor or entrepreneur that keeps the other side informed every step of the way and treats it like a team, then it would be a very different multi-stage relationship.
Yeah, and let me just add one other point too. If you are very early stage, pre-revenue, you're still figuring out your product. The variability on your projections are going to vary widely. So that's why when you are raising money, if you've already reached a point where you're growing a particular market, it's much more predictable what's going to happen. The relationship is going to have sort of more opportunity for success because there's just less variation. And so waiting longer, in my view, and I didn't do this earlier in my career, but waiting longer to take money and capital is really now sort of the mode of operation that I'm in, because that makes it, one, I'm not relying as a crutch on somebody else's money. I'm building value based on our ability to execute. And then two, I think there's much more predictability about what the future is going to hold, given our kind of past experience.
Yeah, we like to joke that the best type of funding is customer revenue. You
don't have to give it back.
That's right. It's non-dilutive.
Yes, I feel like that's sometimes the case after you're in the deal, but not necessarily before you're in the deal, depending. Anyway, actually that brings me to my next question, which is, we'll call it kind of founder red flag. So things that, when someone's fundraising, or from your experience, you're doing the fundraising, you learned that were terrible things to say, things that kind of indicate this person doesn't necessarily know what they're talking about. So I'll throw myself on the spikes first. I remember early in my fundraising days, I would go in, I would do this lovely presentation, and it would kind of climax somewhere about how, and then we think in 12 to 18 months we're going to be cash flow positive. When I was raising venture capital, you think, well, I'm building a business, cash flow positive. That's what you're going for. But actually, if you're talking to investors, and I'm saying, look, I'm going to be cash flow positive, I was saying, look, here's my lifestyle business. And so, no one ever bothered to tell me, why did you say that? And so I'd pitch this for a long, and I never knew for a long time that I shouldn't be pitching cash flow positive as like the great, end point of my venture pitch. Any other red flags that kind of jump out at you as like, I can't believe someone would say this, or I can't believe I used to say this?
Well, I mean, there are a bunch, but I think in fairness, and we see 1,000 deals a year, I think, most, compared to 10 years ago, I think most entrepreneurs that make it to our doorstep one way or the other are relatively well prepared. And there's few cases where there are just obvious red flags that pop up from screening. So I think that's a credit to the fact that there's there's a lot more interest in understanding about entrepreneurship generally. But that's an interesting one you mentioned, and it's one we kind of joke about a lot, which is what are the projections that you're showing, right? If you show the proverbial hockey stick where you're going to have $75 million in revenue 4 years from now, we're going to beat you up and tell you, that's ridiculous and it doesn't make any sense. But if you show us a projection that's much more grounded where you say, okay, we're going to have a $9 million business 4 years from now, we're going to go, well, that's not large enough to be interesting. Why'd you come in the door? So we understand that there's this tension between those two extremes. And what I tell people is you have to demonstrate that you're grounded in reality, but be able to sell me on the dream and the possibility. And that's a tough thing to do. I think the last point related to the example you gave is we do see a lot of projections still where people are giving us a 3 or 5 or whatever year growth curve, and they never raise any money other than this initial round, which again, if you are going for venture funding, that's probably a very unrealistic expectation. And if it is your expectation, you need to be very selective about what firms you're targeting because that doesn't fit with most of their models.
To explain that is because if you don't raise another round, the valuation of your company doesn't increase, at least on paper, which makes it harder for the venture capitalist to go out and raise his next round of funding because he's got to...
That's not why I care. It's because if you don't need to raise another round, you probably aren't spending the money as fast as I want you to spend it, and therefore you probably aren't growing as fast as you should be growing.
We'll say there's multiple reasons.
Yeah, well, so I think a couple things. One is I'll never forget. Back in it's probably early 2000s. Maybe it was in 2000. There was a slide I remember vividly. We built this projection and we titled the slide "The Mother of All Hockey Sticks." I think back on that now and I'm like, I cannot believe we actually thought that added any value. I mean, and then I think the other part of thinking about growth goes back to something I also mentioned earlier, and that is that 1/10 of a $100 billion company, nobody believes that you're going to get 1/10 of an existing $100 billion company, or 1% or 2%. It's these large existing businesses they're already established, and it's very difficult to try to to break in and get that in a credible way. So you might say, okay, I've got a $10 million forecast because I'm going to get this really small percent of this massive industry. And the math works on paper, but practically it's really hard to do. So it's in some ways, building a story that first is around, there's this market that, we're going to go in, we're going to dominate, it's new. We are able to, maybe the total market's only a $50 million market, but we can credibly get in and dominate that market. And that's not going to be a big enough market for John to invest in. But again, you can show you can dominate it, and then you now move into some of these larger markets that give you an opportunity to grow.
So I have kind of a very different perspective on this, and Aaron, this question was not on the cheat sheet. So
you could fit it in there.
You never told us this is going to be on the final. So basically, what I was reflecting on, and the reason I wanted to kind of take time while others were talking was what made me successful, because I have a lot of experience in failed businesses. I have a little bit of experience in successful businesses. And if I could point out to one red flag that is consistent in all my failed businesses is arrogance. I went in with a lot of arrogance and I was not willing to listen. This is kind of counterintuitive because most people say, do what you believe in, and if you believe in something, you will make it happen and chase your dreams and all that stuff. That's all bullshit. In reality, you have to make this decision almost on a weekly basis, whether you pivot or persevere. And the perseverance is actually a good thing if it is done with some thought behind it. So that's really my only red flag, that as long as you as a founder or as a bunch of founders, co-founders are willing to kind of process the data and turn it into information and integrate that and listen to other people and then still make your own decision, that's basically, if you're not willing to do that, that's a major red flag. I want to talk more about green flags because I think they don't get emphasized enough. founders who are self-aware, that know their strengths and weaknesses, are really, golden, in my opinion. And even if they have a bad idea, I would still invest in them, because the first thing I'm looking at, the judgment I'm making, and I'm a little bit earlier stage than you are in most of my experiences. So I'm looking at investing in the founder more than the idea itself. So it's the founder and the space they are in. If they are in a growing space, even if they come up with a bad idea and they're a good founder, I can do something with them. But if they are in a space that is closing, like, so if you come to me and you are a great founder and you have a great idea in mainframe computing, okay, there's no hope for you. Okay, I'm not going to invest in you. But if you have an idea in some growing field, then, but don't take that into saying, okay, I need to have all AI in my thing. So I had like a recent pitch
AI,
deck.
blockchain,
Blockchain and all that
app.
stuff. I had a recent pitch deck that had like, AI-enabled artificial intelligence. I didn't have to look any further in that pitch deck. I was like, done, right?
So how much you put in?
Yeah, exactly.
You let the computer figure it out for you. So this is great. I know there's a lot more questions we could ask. I know we're kind of running low on time. I want to give you a chance to ask questions. So let me just ask one quick one. To learn more about venture capital, strategies for learning more about it, whether it's from a fundraiser perspective or because you're getting interested in entering the industry, resources, thoughts, techniques, what?
So I'll say one thing, and I think talking to investors is really good. Going out and meeting with guys that are looking at deals, even before you seriously want to raise money, is a great thing, because and having a conversation, explaining what you're doing, being transparent with them, not doing a pitch, but I mean just talking and then getting their feedback is immensely helpful, because it then guides you to kind of give you cues. Should you go down this route? Is this really a venture backable company? So I think that's a wonderful thing to do, even well before you really seriously start raising money.
Yeah, think of it as customer discovery. I mean, the same way they teach you in entrepreneurial classes that you need to go do your customer discovery from the product side, do it from the investor side with respect to the product. And again, the product in that case is you and your company.
I think the most important thing to realize is the kind of training that you're looking for is not taught in books, and it is very difficult to teach in classes. So there are very few people that can pull it off. So you're looking for some Yoda that you can basically trust in. Yoda as in the Star Wars Yoda, that you can trust in, and you want to be able to go to them as suggested that and do the networking thing, but do networking thing from a different perspective. See what you can offer them. See if you can solve their problems so that they take you on as somebody, as a mentee, so that you can shadow them for a while. Play with their money and their time before you start playing with your money and their time. That's all. So don't really start, and I made this mistake, by the way. I invested money originally, just because I got emotional and I said, oh, this is cool, and I invested like $25,000 in a company that was making self-cooling cans based on the Joule Thomson effect, and being a scientist, I said, well, that's really cool. I'll put in the money, and the rest is kind of that money went away. But that was a really good experience. So you want that experience on somebody else's nickel, if you can.
And one thing we can say about my experience with investors is probably yours as well, is they are wonderful at talking to you. Like it's kind of part of their job. But it's something that Lister, who is your partner, who I've had a lot more engagement with, he would happily meet with me anytime, even though I was way out of his market, not quite the right space, not quite the right timing, give me tons of wonderful time and wonderful advice. And so that's something that I really have to tip my hat to most investors. They will talk with you and they will teach you if you're willing to listen. So there were some questions. Do we have time? I don't know how much time we have, maybe 5 minutes for questions. Questions?
So there was a question earlier that you deferred.
Question about founders. So just to repeat it, she was asking about what do you do if there's conflict between kind of what the direction or a decision that the founder or CEO makes or wants to make and what you as an investor or board member would have them make. And one thing that I think another thing a lot of folks don't understand about venture capital as distinct from large private equity is a control business. They come in And when they buy a company, they control the company. They are calling the shots from the board on down. And if the CEO and the board has a disagreement, the CEO is going to be gone very quickly. It's a very different model. The venture capital model is minority investments. And even if the investors as a whole might own a majority of the company, there's not going to be any one investor in almost any cases. There are exceptions that owns enough of the company to make any decision independently. And one thing you learn, and I had to learn again through experience early on, is it's a consensus building business. That's all it's about. I have almost zero authority to make anything happen with respect to my portfolio. I have to, in cases, I either have to convince the management team and or I have to convince co-investors, or I have to do both. And if there is a divergence of opinion with the founder, CEO, that's really problematic, and and that's tough because the founders are still a critical point of risk for us through probably, I would say, in most cases, the first 3 or 4 years that we're in a company. And it's, even though you could maybe technically do it, it's very problematic to have to remove a founder. As a company grows and gets larger, that, you know, the single point of failure risk goes away. But you need to try and work it out. And ultimately, as an investor, your main course of action is to just not continue to invest. And that does happen on occasion.
Yeah, you hear these kind of horror stories from the entrepreneur side of investors kicking out the founder, but if it happens, right, John isn't just going to be like, I don't like you, get him out. He will have built a big
nuclear
consensus.
option.
Yeah, it's not the thing. It's the last thing he possibly wants to do.
Unless it's Sean.
Yeah, you mentioned that private equity very controlling down as far as making decisions. Is there any low-hanging fruit that, as an investor, you like to come in and change or streamline with your investments?
Well, it depends on the company. I would say, and I'm a finance guy by training, so I'm biased, but I would say one of the more frustrating things for a big chunk of our companies is I think they really don't pay enough attention to their financial reporting. And I think because they're small and because they're young, they think that there's not a lot of value add to really putting time into it. And most of our, especially our first-time CEOs, they think of it as a reporting exercise. I do it because it's in my investment documents. I have to do it. But you know, I have a bookkeeper, and they do it, and they get them to us late, and they get them to us bad. And the ones you find with the folks who have done this more than once, they understand that it's actually a valuable tool if you do it right to run your business and understand, because again, it's more data and it's more metrics. So that's one thing that I try and encourage my teams to understand at an earlier stage the value of having strong financial reporting in the business.
And just to take that one step further, also using that financial reporting to make forward-looking decisions.
Right, that's the whole point.
Yeah. So a lot of people think that this is something that we just need to get to the investors.
Right.
So a company that does that very well, for example, one of the Duke Angel Network company is Cambier lotion. They make a hand lotion for, I'm putting a shameless plug for them, a hand lotion for sweaty hands and feet. And they actually, it's really an online sales business. They have a product that they are pushing through, and they can push really any product through, but they actually go into the analytics of where they are getting most sales, how to kind of generate the repeat business, how to convert single-use customers to permanent customers, and so on. And that's what you want to do with the financial background, not just report. Yeah.
Probably time for one more question.
So, to the extent that you try to avoid investing in essentially lifestyle businesses, there are a lot of business models I can imagine where you have some revenues while you're building a product. Maybe you have a service that you're providing while you gather data that you're going to package into a product. That's the real value of the company. Are there business models like that you tend to avoid because it's an easy trap to fall into just providing that low value service? or is that always like de-risking?
Well, I think for a long time, we wouldn't invest in services businesses because of that problem that you worry about scaling and you worry about, and so we were, and it's not uncommon that you see, especially like technology integrator consultants who work with software, putting it into the enterprise, who come up with, and they kind of come up with a product or an idea for a product on their own, and they put a pitch together, and they come to you and say, okay, now we want to go market our own product. We've been doing this as integrators. And I think the thing that we look at there is, does anyone on the team actually have experience selling and scaling a product as opposed to consulting around a product? Because they tend to be pretty different people. And so that's kind of probably a more specific answer than you were looking for, but that's one type of thing. But we've gotten more comfortable taking the other side with tech-enabled services businesses if we believe they're scalable and you can build something big and has attractive value. I mean, and the number one example of that, which is very much still in the news, is Uber, right? If I ask you, is Uber a technology company or is Uber a services company, it's both. If you look at its margins, it's more like a shitty company, but it's at best a services company, right? But it's huge and it's scalable and it's the most valuable privately held company in the world. So,
just to add to that thought, the two things that I'm looking at is that would this be able to scale without a significant impact on the fixed costs and the number of people required? So if you look at it, for example, if a very simple business where you are running charter airlines and you have your own plane, if you are planning to buy your own plane and own planes, that is not scalable. But like Uber, where if you can use other people's equipment, other people's money in order to scale without increasing your own fixed cost and increasing the number of people that you need to run that business. So can this business run without the founders actually being physically in every place? Initially, you'll have to do things that are not scalable, where the founders would have to really get deep into it and really understand it. So, I mean, if I were starting something like Uber, I would actually drive the cars myself to really understand the business. But at some time, I need to construct a business that anybody can use without any human actually getting involved in it.
Yeah, and the last thing I'll say is that on any technology, to be able to just get somebody else to buy it is actually quite difficult. It's in some cases it's easier to build it, show how through your own use of it and deployment of it, how it works and how it achieves the goal that you have as a business. One, you get to also see if it in fact does work and where the issues are. Two, you get to hide where potential problems might be. And then at that point you can begin to deploy it and have others just use the technology. And that's essentially how we've also approached our current initiative.
Thank you so much for taking the time to stop and talk with us. We really appreciate it.
Thanks.
Thank you.